Welcome to the Invest with Clarity podcast, where you will learn how success in investing, as in life, is the result of absolute clarity. Mark Pearson of Nepsis in Minneapolis, Minnesota, shares his passion for portfolio management and commitment to transparency and communication to allow investors to fully understand what they own and why, bringing them to clarity in their investments. And now, here are your co-hosts, Matt Halloran and Mark Pearson.
Hello and welcome to another Invest with Clarity podcast with Mark Pearson. And today we also have our good friend Chuck. They're going to be waxing philosophical. In fact, we're going to finish up a mini-series. This is episode number 4 of this 4-part mini-series. Hey guys, was it 4 parts or 5 parts?
5.
Oh my gosh, we even got one after this. That's even better. So I just a total cliffhanger for everybody.
That's all right.
There's going to be another one after this, but today we're going to be talking about putting the Nepsis portfolio to the test. But before we get into that, Chuck, remind everybody what the first 3 podcasts were, and then at the end we'll preview what number 5 is going to be.
Yeah, absolutely, Matt. Thanks. Great lead in as always. And we started this off by trying to say why it's so important to know what you own and why you own it. So the first one of these in the series was certainly about eradicating emotion. It was about the Dalbar study, why it's so important. I just want to read what they said in the most recent study. The greatest impediment to one not reaching their own personal investment goals is using emotion in the decision-making process. So we talked about that. In episode 2, we actually drilled down into emotion. And we talked about the emotion of fear is really what grips people from both sides. So we hear a lot about fear and greed, and certainly there's some greedy people in this business, but most of the everyday investor has fear, the fear of loss, running out of money and becoming destitute, but the fear of missing out. We call that FOMO, that others are earning more than you are. And we talked about how you overcome fear through confidence and certainly the clarity message. Episode 3 is a really good lead into this, because what we then did is said, okay, what type of portfolios best demonstrate to an investor that confidence? How do they get confidence? They get confidence through clarity, and that clarity comes through that knowing what you own. So we talked about how managers actually build a portfolio that allows their investors to best understand what they own and why they own it. So as we kind of pivot into this one, Mark, we're going to put the Nepsis portfolio to the test. So we talked about in episode 3, right? Do we really emote clarity to our investors? And you and I know the answer to that, but I know you're just going to do unbelievably well on this one.
Of course. Now, before we get into the Nepsis portfolio, a couple things we should tell the listeners.
Sure.
For compliance reasons. Number one, any position that we do mention here is not a solicitation. It is not a recommendation to buy any one of these positions in your portfolio. Additionally, of course, by the time this podcast, there is a strong possibility that there may be minor changes to the portfolio. We are active portfolio managers. We've been going through a great correction. So today, quite frankly, we did a lot of buying of a lot of the companies we own because, hey, who doesn't love a good Christmas sale, right, guys? So
you got it.
People need to understand that this is a snapshot in time, and the only people that get to really see exactly what's going on in their portfolio are clients, because they have full transparency to see everything that's happening within their portfolio. So with those disclosures, Uncle Chuck, out of the way, go ahead and rip at it.
You got it. And what I thought was so neat, this is for our listeners. So here we are a couple of days before Christmas, and Mark and I were fully prepared to do this podcast. And Mark sends me an email and goes, hey, Chuck, did you read that article today in the Wall Street Journal about how ETFs are constructed, and can we use this? And the funny thing was I was actually reading the article as you sent that to me. So maybe it's the great minds think alike thing. But
yeah, listen, I tell you, it was a gift. I just saw it on CNBC.
Exactly.
And I'm like, Chuck, we got to send this, because I literally talked to one of my advisors today who has a client who has 2 complaints. Number one, he thinks that he should be making more money than he is right now.
Oh, boy.
And number 2, he's been a client of ours for about 8 months.
Okay.
So much for long-term investing. And it's possible that we aren't meeting his expectations. But as we used to hammer many times on podcasts and our old radio show, people live and die by the idea of comparing their portfolio to an index or to a market or to their friend's portfolio.
Right.
And maybe this person is comparing his portfolio to someone else's who's completely different, maybe has a different investment strategy. And as we've said it 1.5 million times, don't compare your portfolio to a benchmark or to a friend of yours or a family member, because the portfolios are going to be different and they may not be invested in a similar manner to achieve your goals.
Absolutely, Mark. No, it's a great lead. And remember, we use the old Teddy or Theodore Roosevelt, that you probably like to be called, the former president, right? Comparison is the thief of all joy.
Amen.
And it's sapping this guy's joy, right? Because he's looking around and saying, oh my gosh, I'm not beating this or that or this person. And
well, we used to talk about this on the radio show a lot, about how the S&P is constructed and that the industry has pushed people in this direction to compare their portfolios to the S&P, which is one of the biggest investment mistakes you can make. I don't care what the media says. I don't care if someone says you should own indexes and you should get as cheap of a money management platform as possible, because cheap, as they always say, Uncle Chuck, you get what you pay for. So at the end of the day, I think people will find the information today to be quite enlightening. Of course, repetition is a spice of life. So let's repeat ourselves one more time today and tell people why they shouldn't do it.
You got it. And it leads into this piece that you were referencing today, Mark, and something called the Pareto Principle, which everyone knows is the 80-20 rule. So I'm going to give 3 facets of what this article stated and then pivot into the Nepsis portfolio, because we're the polar opposite. And that's, I think, what we want to get across to the listeners today.
Opposites attract.
Yes, they do. And marriage and a lot of other things, right? It's a spice of life. I love it. So here we go. So think about this. Within the individual S&P 500 sectors, so we're going to look at sectors. So remember the articles, I should say the commercials a couple of years ago about you get away from individual stock risk when you buy an ETF. If you remember, they were trying to push that a few years ago. So here's the data. And it's incredible. So in 5 of the 11 sectors, so again, the stock market's broken up into 11 different sectors, industries, whatever you want to call them. Think about this. Here's what the article said, Mark. The 5 largest companies account for more than a half of the ETF's total market cap in 9 out of 11 sector ETFs. Less than 10 companies account for more than half of the ETF's market cap. So think about this. Here you are, this investor, right? You're like, well, I diversify by sector. And if I buy these 11 different sector ETFs, I'm going to be diversified. When that's just not the story. So what the article said is one of the primary selling points of ETFs is that they allow investors to get diversified exposure to a specific market or sector. But when you look below the surface of a number of market cap weighted ETFs, almost all of these are top heavy. And when you slice it, Mark, and I'll just kind of give you the numbers here that we saw.
By the way, not to interrupt you, but
no, that's okay.
Many of the mutual funds that I have seen that have had outperformance on a consistent basis, they're always top heavy. The question then becomes how many companies are owned within the investment itself, whether it's a mutual fund or an ETF.
That is so very well said. And that's what we're going to do with the Nepsis portfolio here today, which I'm just so excited about, because when you look at how the industry has duped people into believing that diversification simply means more in number, and it's not the case. And what we talked about last time was that one of the tenets of having a portfolio that over time meets the expectations of investors is actually the smaller number of equities within inside of a portfolio. And you've talked about this before. It's the underlying conviction within the company. Just throwing a bunch of ETFs together is not going to do it, especially those that are constructed based on market capitalization. So let me just define that, Mark, right? So market capitalization is the actual price of the given stock times the number of shares outstanding. So we're going to mention some names. Again, we're not actually giving buy ratings on these, but if you think of an Amazon and an Apple and a Microsoft or a Tesla or an NVIDIA, Good, bad, in different companies doesn't matter, but they're large because their share count is very high and their price is very high, right? That's
Right.
market capitalization.
This gets a lot into what Matt and I discussed last podcast. So if you haven't listened to the last podcast and you're listening to this one first, you may want to go back and listen actually to the last two podcasts where I dug deeper under the hood as it pertained to investment philosophy and investment strategy, because those pieces are what determine the portfolio structure, which is what, Chuck, you are getting into in terms of over diversification. I have referenced studies, and there's a bunch of them out there that will give you different numbers, but it seems like, and correct me if I'm wrong, on average, most studies show that a portfolio of 20 to 40 companies is actually appropriately diversified. And once you get above 40 companies, you actually start entering the law of diminishing returns.
Absolutely.
And so when you think about, hey, I own all these indexes or I own all these ETFs, it's quote unquote safe. This is precisely why when you get into a situation where we're in right now with this correction that's been going on, that's much bigger in the NASDAQ than in the S&P and Dow, it has to do with certain categorizations of stocks, and that asset allocation is more important than diversification. Let me say it one more time, right? Asset allocation meaning where you invest in different asset classes or in different industries, and the percentage of what you own or those are more important than owning lots and lots of stocks.
So very well said. And I think, again, it's an excellent lead in to this test. I failed to mention this, but when we spoke in episode 3, we referenced the Athena Invest and Thomson Financial data that you just said, Mark, that looked at if you simply take 40 stocks. So this is this study that I think is so paramount in this idea of conviction and then the consistency of your conviction. So think about this. We talk about what alpha means. Alpha very simply means, is the manager adding value by choosing a given security or a set of securities? So just think of it in that way. So think about this, Mark. So if you take the top 20 stocks, you got 40, the top 20, the top 10 adds an extra 6.1% of over the market benchmark. The next 10, 2.3%. The last 20 on average, this is for money managers on par, is negative 4.7. That's that law of diminishing returns that you just got. So the key is, and you talk about this all the time, and I love it, do you have conviction? How does a money manager speak about the top 10 holdings? And you can just reference from the tone of voice, again, and the emotion that is involved in that decision making truly allows a manager to outshine. And that's what we're going to look at the portfolio today, Mark, and see if that's instilled here in the Nepsis portfolio. So let's take a look at it. Now, here's the thing that I found, Mark, which was amazing. I know you love to benchmark against what I think probably is the most indicative of how money is managed at Nepsis, the ACWI, right? The all
Okay, but wait, just to clarify, I don't like to benchmark. I don't benchmark. What I will do is I will reference that index to let people know this is how we asset allocate.
Stand corrected. You are
no problem.
Yes.
We're just splicing words there, but just for, if we have introductory listeners who heard me shred benchmarks on the last podcast, clarification should be made that it is used to let people know this is how we asset allocate across those asset classes.
Yeah, and thanks for that clarification. The interesting thing is that I've found, and we've been doing this for quite a long time, is that the ACWI, the All Country World Index, invest in businesses globally, but there's no small companies in it. The Russell 3000, which is very simply the 3,000 largest stocks in the US, owns small caps, but it doesn't own international. So the beauty of the non-constraint that we actually live by at our firm, there really is no benchmark, if you will, that is even out there. And I think that even speaks to how our industry compiles this set of comparisons, right? With us, there really is no comparison other than, hey, is our investor, are they meeting their expectations and their goals?
So one thing I think is important for those that may not know, why don't you explain what constraint means? A lot of people don't understand how mutual funds or how exchange traded funds are structured.
I love it. This leads into the second piece here, which is just fascinating because the structure of this portfolio composition, no matter what money manager is, drives the flexibility. So it's just, think about Morningstar, right? They've compiled what to many people looks like a tic-tac-toe box. So you have 9 squares within a larger square. And what Morningstar never intended to do, but the industry unfortunately has allowed it to get this way, is constrain managers to one of those boxes. So let's just say you're a large value manager. You can't buy small cap, you can't buy growth, you can't buy anything outside of the box to which you're constrained.
Not to mention the idea that more than likely, I don't have any examples for full disclosure, it's quite possible that mutual fund managers and ETF managers may get paid bonuses for performance in their portfolio. And I'm not saying it does, but as my good friend Matt Halloran would say, is it possible that it could skew some decision-making processes?
Oh my goodness. Matt Halloran is 100% correct. Absolutely, it does. We remember at Nepsis, Mark, we have this 5-question test. So it's basically, is your manager, for those who are listening, are they flexible or do they have constraints on them? So let's walk through this. So the SMA structure, right? The separate managed account.
Meaning, explain to them what that is.
Certainly. So we're going to walk through the 5 qualities that, but a separately managed account is set up at the account level. It's customized for that individual. Now, we're going to have some cross-reference across the board of clients and their holdings, but it's customized for them. When you make a change, it's made at the account level versus a mutual fund manager, ETF, at that actual fund level. And there's a huge difference in that.
So the benefit of that, of course, to let people know is, number one, there's greater flexibility at the account level and there's greater transparency. Funny, the 2 things that Matt and I are going to cover in a future podcast.
Great lead.
To get to the 4 keys of successful investing. The other benefit of an SMA is the fact that everyone's portfolio is true, but each individual investor has different needs that may come up in the course of life. In a separately managed account and having money managed at an account level versus at a pooled level, meaning all the money's pooled together with other investors, is that there's greater flexibility to tax manage an account. There's greater flexibility to manage around legacy holdings in a portfolio, and flat out, bluntly, gives the investor the greatest potential, no guarantees, we have to say potential, for investment success over time.
I love that. So let's summarize the 5, right? So the SMA, customization of holdings, where a fund/ETF built for the masses. Here's one that you didn't get to, which I think is so important. SMA, continuous interaction with the manager. You're explaining, knowing what you own and why you own it directly to the investor, where with a mutual fund, there's no interaction. You can't have that. You can't go to a investor and say, hey, we're going to sell X and buy Y. That would indicate front running. So there's a huge difference between the 2. The SMA's dedicated single investor account, mutual funds pooled ownership. Here's another one, Mark, that I think is interesting. In the SMA structure, you're always knowing what you own and why you own. A mutual fund has a controlled messaging. They can only go so far as to the reason they're buying X and selling Y. And then you mentioned the last one, number 5, which is this tax efficient process. In a mutual fund, the taxes are determined by the turnover, right? When the manager sells something, the company sends out the capital gain report, and you get stuck with a bill that you really had no control over.
You really do put some good stuff together.
I learned from you, my goodness.
I don't know about
what
that.
What would you expect, right?
I don't know about that, but thanks.
No, it's true. And everyone out there should know it. But the next one is interesting, Mark, when we took the test again. So we walked through the Morningstar software program. And what I found interesting, and this is how Morningstar breaks it down. So we have in the portfolios a deep level of conviction. So what Morningstar does, it says, here's a given benchmark, and here's how it's broken down by sector, industry, but here's how our portfolios are aligned currently. So,
by the way, before you go into that, I just had a thought, a little bit of an epiphany, that Matt and I didn't talk about on the last podcast we did about after I shredded benchmarks and say, why don't you use benchmarks? And there are still people out there that will ask, well, if you don't use something to compare your portfolio to, how do I know if my portfolio is doing well? And I say to them, thank you for finally asking the right question. Not how did you do versus a benchmark?
Right.
Question is, how do I know my portfolio is doing the best it can? And there are multiple reasons for that. First of all, number one, I find it interesting. I find it refreshing, and I find it important that investors should understand that for a company that has been around now for 26 plus years, we are considered in our business to be a medium to large investment firm, that we have virtually no turnover, very, very little turnover
In client accounts,
in
right?
client accounts,
Yep.
meaning people don't leave because they're not happy. Now, money leaves because they've got money needs or their extenuating circumstances. And quite frankly, you're never going to please everybody. But when you can have a retention rate of 97, 98% or higher, that's pretty good. I mean, we have 860 clients, 870, whatever the number is. And I don't know how many clients we have lost, but I got to tell you, it's got to be less than probably 20. And of course, we're adding more all the time. So number one, client retention. Number two, more importantly, am I on track to accomplish the financial goals I want to accomplish? I can't tell you how many times investors have asked our advisors, or you have asked me over the years, why isn't my portfolio doing as well as the S&P 500? Which, of course, I hate that question. And people say, well, you hate that question because you don't do as well. Actually, that's an untrue statement. That said, fact of the matter is that what is most important is that the investor is on track to accomplish their goals, which may mean that you're in an income and growth allocation or an income allocation or a balanced allocation. And if you think you're going to perform as well as any equity index that's long-term that owns 100% aggressive stock-wise, your expectations are off the charts. Balanced accounts, income and growth and income accounts are not designed to perform at the level of the performance of the major indexes. So those are three important aspects. But most importantly, as you meet with your advisor, hopefully here at Nepsis, you will find out that you are on track, or hopefully on track, to accomplish your long-term investment and planning goals.
Excellent, Mark. And it really takes us to this piece, and I want to open you up here. I know we probably got about a little less than 10 minutes to go here. We got a couple of things to cover, which I think are really key. So I want to walk down this conviction area in sectors, which is huge. So
Yes.
we looked at the portfolio, right?
You're going to test me, aren't you?
Well, yeah, you know this like the back of your hand. But I think, correct me if I'm wrong, technology is always going to be there as kind of a weighting. It's your area of background. I mean, that's how you got into this business, right? 30
Yes.
plus years ago. So
Yes.
we always like tech, but there's three areas we found. So we found energy, a significant overweight. The portfolio almost has 16% in energy. We got financials, about a third of the portfolio, and then healthcare. Remember when we were doing our advisor call a little while back, we looked at the three characteristics of those. They perform well historically under an inflationary period. The
Yes.
businesses today are selling at a discount. And
Yes.
talk a little bit about the top down, if you will. If you look at the economy and where it's set, where we got high inflation, rising interest rates, most likely, how these three sets of businesses do well in this environment, most likely we're going to see next year.
Quite frankly, the first thing I should say is people listening to this podcast are going to actually think that we practiced this before we got on, because your question is excellent. And the fact of the matter is we actually don't practice.
We don't.
So we don't need to. I talked about top-down, bottom-up investing last podcast on the strategy part. And when you talk about top-down, when you look at what happened during the COVID period and the economy shut down, there were three really big components that stood out to me that engaged me to make the final decisions. Of course, we talk as a committee, but to make the final decisions to start a macro shift in our portfolios in the fall of 2020.
Right.
And those shifts were, number one, with so many people staying at home, you're going to see a significant supply and demand imbalance on people needing things. And when you think about just some common sense things, Chuck and Matt, one of them is people weren't driving for a long time.
Exactly.
And planes weren't flying in the air, which said to me, okay, that means that the oil companies are going to stop drilling. Oil companies have already come out, many of them, and said, like the last two cycles, that they were not going to do what they did in the last two cycles. And in those last two cycles, what they were going to do was as the need grew for oil, they increased production. And so they had all this production going on. And then when the economy came to a complete halt, everything got shut down. Well, what most people don't realize is when everything got shut down, it could take 9 months to a year to ramp energy back up, to ramp up production in energy to get the supply out to meet the demand. So I felt energy had to be a place it needed to be. And this is the flexibility part. This is all public information. Again, it's not solicitation, but take Devon Energy for an example. 2014, 2015, at the peak of Devon Energy was in the 70s or 80s, maybe 100. And at the bottom of this crisis, it got down to 7.5. And right now, Devon is our largest holding because as we were coming out of COVID, Devon was trading between $9 and $11 a share. And today it's trading at 41 in a year and a half. I still think energy is undervalued as a whole because now with this Omicron thing, people are still cutting back on travel. Airplanes and cruise ships and other energy things that use oil, that use gasoline, are not at 100% capacity yet. I just think that no one understands really how much we're going to be short on oil eventually. And again, this is just my opinion. And when the energy companies come out and say, we're not going to do what we did the last two cycles where we're going to increase productivity, our number one goal is to return shareholder capital, which basically means energy companies aren't going to go out and expand production a bunch. They're going to return capital to the shareholder, which means there's not going to be huge growth in productivity or in production, especially with the shift that we're seeing to more energy efficient, clean energy in the process. Number two, think about it. If you've got an energy problem, you don't have enough oil for people, what does that click into? Higher gas prices.
You got it.
Gas prices are what's called inflation. When you have a supply chain that's going to be backed up, which we saw coming in that process, that means things were going to get more expensive. And so what you had was this dichotomy going on between growth stocks and value stocks. People had spent so many years buying a stock based on price to sales and not on price to earnings,
right?
Which is the historical, one of the more important components of measuring value of business. Now, I'm not saying you don't buy a company based on price to sales, but generally speaking, in an inflationary environment, that bodes better for inflation. It bodes better for, therefore, financials, healthcare, and still technology, but very, very hyper-focused on the technology that you buy. So I thought those would be important things to tell why we made this shift into many of the areas that we did, really starting in the fall of, call it 2020, summer 2020 in that area. Now, we still owned a lot of more growth and value, but that's where we started buying some of these companies you're probably going to mention here.
And I love that because it gets to the third component of these four. And not to get wonky, but we call this tracking error. So here's what we did at Nepsis, right, Mark? If you look at the benchmark, energy's 2.7% of the benchmark, which is with Russell 3000, which is minuscule. Our portfolio is nearly 16. So we're nearly 6x the benchmark. The flexibility followed your conviction in areas which you just explained it exceptionally well. And that's how a money manager actually can outperform. The tracking error, meaning, okay, if you're tracking a benchmark, which we're not, the more the merrier. Why is that? If you're good at what you do, and 26 years hopefully is evidence of that, the broader way that you skew away from a benchmark, if you're good at what you're doing, is how you create manager value add. So if you were to look at, I know this is our standard deviation and our beta, which are just measures of what people call risk. If you have a higher number, you're deemed to be riskier, and we do, but we don't look at it that way. We view it as something, it's paramount. You've talked about this before. Paramount's
That's
a huge
the volatility
word.
factor.
Exactly. It's the volatility factor, which we're going to end on here. And our industry, again, continues to beat the drum that volatility is bad, it's risk. It's not. It's just the other side of the coin. It's just opportunistic.
I mean, I knew you were smart, but a new word. Matt does that all the time on the show.
It's
here.
like strategery, right? We come up
exactly.
with
We got strategery going.
We do have it going. So I wanted you to kind of end on this, just again, talk about the volatility. I know we almost talk about this all the time, but our industry's gotten it wrong. The greater, the better. That's the fourth one. We want it to happen. Please tell the audience why we want volatility and why it's paramount, necessary in the process.
I would just say, ask one of our clients who lived through COVID with us, and they'll tell you. I mean, when they literally got to sit at the computer and look at their portfolio and see all the activity going on when the markets were lower, we literally had one of our advisors, one of his clients, tell the advisor to tell me to stop making him so much money during COVID. And portfolios went down. It created a tremendous opportunity. And historically, you know, in the last 15 years, there's only been 2 years where really we had what I would consider to be unsatisfactory performance in my own mind. And it had to do with only one company in the portfolio. And the one company caused this much of underperformance. And we still own that company. And we're long-term business owners. We just believe that over time, it's not time in a stock, it's time in a stock. And now that it's 3 years later, clients don't talk about that one stock anymore because it's such a small position. This gets to the aspect of asset allocation, buy discipline and sell discipline in our philosophy and strategy.
Absolutely. And I am so excited about this as we wrap a bow around this one. When we come back, I think we're doing one more next week. We're going to go through the 4 podcasts. We're going to review them, and we're going to provide a summary review of all of the ones that we did. Well, I've really enjoyed this time, Mark, and I'm looking forward to the next one. So I got a week ahead of me to do a ton more research, but I think we'll provide really some good information for our listeners.
Well, as usual, it's always a pleasure to have you on with me. Matt likes it because he gets to take a nap during these and not really have to say anything, right, Matt?
I'm totally listening. We're going to have a little conversation about my name used in vain repeatedly throughout the show without me wanting to interrupt you guys.
It's only in love.
Yeah, Chuck, it is absolutely fantastic for you. Every time we have you on the show, I mean, it's so nice to have your insight. It's neat to hear you and Mark go back and forth and wax philosophical on this stuff. And for those of you who don't understand, there are a couple of miniseries that are going on right now that really lay the foundation and retell the Nepsis story. And I really love for each of you, if you have not subscribed to the show, make sure that you do. And if you have friends and family, because this is all going to be happening, we all get together every once in a while. When you're sitting around, you know, the dinner table and you've got a friend or a person and they're saying something that you just know is utterly ridiculous because you listen to this show, please make sure that you share it with them, everybody. It's important. And the reason why Mark and everybody at Nepsis does the show is because the goal is to inform people to have them think differently, but most importantly, for them to understand what they own and why they own it. Closing statements for either of you before I wrap it up?
No, you wrapped it up perfectly. Appreciate it.
All right, everybody. Thank you very much. We will see you all very soon. Make sure you subscribe to the show, and we'll talk to you very, very soon. Have a wonderful day.
The content discussed is for informational purposes only. It is not a solicitation or recommendation for any securities that may be mentioned herein. Advisory services offered through Nepsis Inc., an SEC-registered investment advisor.